All right. So we now take a typical example of a cash flow. All right. So consolidated cash flow. Now, Feed Me Limited is the question, and it has been in operation for over 2 decades. And we are told that they produce Tobamao, natural cocoa powder, and everything. 5 years ago, they acquired 100% interest in Butane Ghana Company Limited, which specializes in importation of cocoa beans from Cote d'Ivoire. Now, in 2016, Feed Me Limited acquired 40% in a competitor. That's Food Company Limited. So we have an associate there. And also on January 2019, there is a 75% interest in the Shawarma Supermarket Limited. And we have the draft financial statement. So this is the balance sheet, consolidated balance sheet. I told you here, everything has been done. Yours is to do the cash flow. All right. So we have all these and you have all the information. Now, we also have the consolidated financial statement for profit and loss. So we have everything in here. All right. Then we have additional information. They say that there has not been no acquisition and disposal of freehold building. All right. So there's no acquisition, there's no disposal of freehold building. Then when they acquire Shawarma, which the one that they control now, these are the information we have. All right. So that is for note 2. Then, so it means this question don't have a disposer. All right. So, when you are doing a disposal, you'll be subtracting. When you are doing acquisition, you'll be adding. All right. So there's no disposer. And they said that the loan note issued were issued at a discount in 2019 with the carrying amount of the loan at 31st December included 600 representing finance cost. You know that carrying amount can't be a finance cost. So wherever that finance cost is in there, we need to take it out. So that is the understanding you need to get. And we are supposed to prepare consolidated financial statements. All right. So we have this with only 3 notes. Let's go and deal with that. We know that for so whose company are we doing this in? And we do know that when you are doing console cash flow, one thing you should always understand and start with is your profit before tax. And that one, we can find it here. All right. So before we even start our working, so this thing is Feed Me Group. Now in Feed Me Group, you are preparing consolidated statements of cash flow for the year ended. So we check our requirements again for the year ended. So what do we have? For the year ended 31st December 2019. All right, so we put in our currency signs. We do a double. Okay. So we start with profit before tax. And how much is that? So we stay in your P&L for the first time. For the time being, 28,275. So that is that. Then what is the next thing? Remember, I said you look up. So when you are looking up, you are looking for 2 things: depreciation to add back, and also all non-operating activities. All right. So when we look up, for example, interest expense, interest is not our daily operating activity item. All right. And so we need to, this one was deducted. So we will add back interest expense. Everything that is non-operating activity, we need to deal with it. So I'll add back 2250. Then what else? We have income from financing activity asset. It's not something you do, all right, operationally. So we have income from financial asset. So that one was added. We will deduct 3,000. All right. Then we have another one, share of profit of associate after tax. Now, this one too, the same thing. All right. So, I mean, as for share of profit after tax, it is not even a cash item. It increases your investment inside your associate. Remember, this is from a general console. All right. So, what we can use these things for are probably for determination of dividends. All right. So, share of profits, and it is coming from the associate. This one too is not your ordinary course of activities. It's non-operational. So since it was added, we will reverse by doing this. All right, so that is that. Then we go and fish out for our depreciation. So after this, I told you stay in your P&L and you go and look for depreciation items. So let's go. Where is our balance sheet? We have our balance sheet. We can prepare a PPE note to find our depreciation and stuff. But we were told in note 1 that there was no acquisition and disposal of freehold building. So what then happens to freehold building? As you can see, we have freehold building. At the beginning, it is 33. Now in 2019, it is 31. What tells you? What will make an asset reduce? Depreciation. So right there, you have depreciation. So the depreciation, you have depreciation for freehold. So freehold building. So what is the difference? We had like the depreciation will be like 31. That is 33, and it is going to 31. So 33,000 minus 31,125. How much is that? Let's take calculator. So 33,000 minus 31,125. That gives me a depreciation, and the depreciation is added back, right? So that gives me a depreciation of 1,875. All right. So now here to plant and equipment, we have accumulated depreciations. So before it is 16,500, then it has increased. What increases accumulated depreciation? It is depreciation. So we have plant and equipment. So that one too, how much is that? The thing is, we are having it moved from 16,500 and it has gone to 18,000. That's 1,005. All right. So we add back 1,005. So this is that. All right. Now depreciation was easy to find, but we still need to go back and do some workings on some of the assets. All right. So in cash flow, you have to make sure you have done workings on all your balance sheet items, and each workings that you are doing, you are going to pick up a figure from the P&L, all right, as part of your workings. So we just want to create a working sheet, all right. But you start with this before you even start your workings, all right. So let's create our working sheet. So we do a workings one on, I think this one, there's no need for workings for this side, but we need to do another one for PPE, which is plant now, plant and equipment. All right, so that we can find out if there is any addition. By God's grace, we've been able to find the depreciation, and we are told that there is no even disposal of assets. There's no even acquisition yet. All right, so we will have to find out if there is an acquisition. So we look at our plant here, and we go through this plant and equipment. You go through all these things. There's also a lease obligation. So if your lease obligation went up, there is lease obligation here and lease obligation here. So you know what brings lease? IFRS 16, which means that there may be a right of use inside your PPE again. So you have to do the workings. If your lease rather reduces, then there is a lease payment. If your lease went up, then it means there is a lease acquisition into right of use, all right, which probably may be in the PPE, because as for the other freehold building, we are told that nothing happened. All right. So let's do our balance brought down. So because of that, we will have to chalk and also be doing the lease alongside. So my workings 2 will be on a lease. All right, so you have balance brought down for lease as well. So let's work it out. My balance brought down, for example, for the lease, I have 1 here, I have 1 here. So what I have is 2,350 plus 3,000. All right, and that I think will be 5,350. So that is my balance brought down. Then I go to my SPL. If there is any lease payments, I will see. All right, if there is any lease payment in my SPL, where's my SPL? There is nothing on lease. All right, so SPL, there is nothing. But I know my balance carried down for my lease will also be, all right, so balance carried down now, we have 10,650 and 3,600. So 10,650 plus 3,600. How much would that be? 10,650 plus 3,600. That is 14,250. The lease is not reducing, so it means there is an addition. There's an addition, and this addition is a lease. It's not a cash flow. All right, so that is where you need to be careful. So it means there is a lease addition. Balance brought down for PPE. All right, okay. So we have used the depreciation already, so you can use the 4,500. Then what is the difference between this one? 5,350, 8,900. So there is an addition of, so this one will come into my workings here. So 8,900. All right. So that is that. I've already catered for depreciation, so I won't be bringing depreciation in here anymore. So you have to be very, very careful about that. All right, so this is what I have. Now, so I turn my attention to my PPE again. So in the PPE, we were told that when they bought the subsidiary, they also bought his PPE. So there is an addition coming through via the subsidiary. That is 2,475. All right, so that is that. That is that. Now, what do we see? My balance carried down is what? My balance carried down of my PPE. So you see, I've tackled each issues in wherever PPE is. I've taken it into consideration. That is how you do your workings. So the balance is how much? We fished depreciation out already, so I didn't include depreciation again. So here is 27,000. So that is what you have. Now, in this case, we need to add and find out everything. Okay, so let's do that. So clearly, when you add everything up in terms of this PP, what you are going to get herein is 12,000. So you have 12,625. So 12,000. So that is an addition. And that is a cash outflow. So addition is 12,625. So that is that. So when we get to what do we call it? Investing activity, we will take care of that. So that is how you do your working. So now we can come back and continue. So right from this side, what we have, we found all our, and there is goodwill. So let's find out the purchase goodwill also. So this is our goodwill. So what is the balance carried down of our goodwill so that we check for any impairment? So where is, all right, it's the same. So it means goodwill has not impaired. All right, so then we can go on. You can go on and do working capital. And like we saw in the very first video, the part 1 video, in working capital, so we start with inventory. How do we go about that? So you will start with the balance brought down. So this is 15,000. All right. Then plus acquisition. All right. So acquisition. And if there was disposal, you deduct. So we acquired these people's inventory. So our inventory here is this. But in the end, if there were disposal, we would have done minus of that. But in the end, what is our balance carried down for inventory? 29,625. So 29,625. So 29,625. What do I have? So I have 15,000 plus 480. That is what I have. That is 15,480. And it has increased to 29. So it means there is an outflow. All right. So 29,625. So there is an outflow of 14,145. All right. Then what about receivables? Receivables too, it started with 19,125. And we bought a subsidiary. That subsidiary brought in how much? 420. So we have 420. If I add 19,125 plus 420, that gives me 19,545. Now, in the end, how much is it? My current asset. It is 27. So that one too has increased. So minus 27,750, right? So minus 27,750. That gives me 8,205. So that one too has increased. So you see clearly that it is increasing. The last thing on our working capital will therefore be our payables. So let's find our payables. So the payables to how much do we have? Where is payable? We started with 4,200 plus what did we acquire? What did we acquire from payables? 1,020. So 1,020. In the end, how much is that? If there were disposals, we'll be deducting disposals, okay? In the end, what is our payable? Is 7,500. So payable too has increased, but when payable increases, so all these things were outflows, but when payable increases, it's a good news. So 4,200 plus 1,020 minus 7,500. So for that one, I have 2,280, and that is an inflow. So we've done the things that affect your P&L. You've also done your working capital. So we now come back to find out these cash from operations. Then we will do what do we call it? Interest and tax also. So basically that is. So let's total. So operating activities. So now if I total 28, this. That is gives me 5580. All right, so I have 5580. So I need to go and do the workings on my workings 3 all the time. All right, so let's do workings 3 for interest and tax. So workings 3, I have interest and I have my tax. All right, so what is the balance brought down? We have accrued interest, balance brought down, which is 450. What is inside my SPL? So the SPL, what we added back was, where is it? Interest expense, 2,250. All right, so that is that. Then I leave my space to come to my balance carried down. What was our balance carried down? 600. Any difference thereof is interest paid. So that is that. So 450 plus 2,250 minus 600. That gives me a 2,100 interest paid. So that is how you go around it. So we will add that 2,100 inside our this thing. But hold on, I think the question made mention of an interest that was inside this finance cost. So we need to probably check that one. We were told that in note, what note was that? So this note, it says that there's a 600 included in this finance, which we all know shouldn't be there. You remember, we all know it shouldn't be there because that is a carrying amount of a loan note. So what we can do is to shift these ones more. And do the 1,002 inside the P&L for this one. So let's do it this way. There was 1,002 inside the P&L. According to the question, what we can do is do 2,250 minus that 600. All right, so that's the 600 part. So whatever we will get is what we will drop here. All right, just a second. So we have 2,250 minus, it shouldn't be included. So I take it out, I have 1,650, then plus 450 minus 600 gives me 1,005 as my interest paid. All right, so you need to be very careful. All right. So when we are doing the loan side, that is the carrying amount. It shouldn't be part of this one. So tax, we have balance brought down. What is our balance brought down for tax? So I see deferred tax, I see income tax. So the two. So deferred tax is 395 plus tax of 3,255. And that gives me, so I have 395 plus 3,255. That gives me 3,650. So I come to my SPL and pick the tax from there. You see, so I have done a note and I've already catered for this interest expense. I'm now doing a note and to cater for my tax. The taxes are 3 here. So I have 5,865 and 1,560, then 675. So total, those ones in my SPL sum to how much? I think it is added here already to give 8,100, right? So I could have just picked the 8,100. So my balance carried down is how much? Balance carried down 450 plus, where are you? 6, that is 6,930. 6,930. So 450 plus 6,930. That gives me a total of 7,380. So what is tax paid? Tax paid will be 3,650 plus 8,100, which gives me 11,750 minus 7,380. That gives me a tax paid of 4,3. How much is that? A tax paid of 4,370. Is that right? So that is that 4,370. All right. Or we just have to check the day when they bought the subsidiary. Okay, when they bought the subsidiary, there was also another tax. So we have to be just careful about these things. So now I need to wait on this side. So it means I need to bring in the part of the subsidiary too, because when you bought the subsidiary, you are bringing in tax. So like normally what I would do is to push it here. You acquire the subsidiary. So the subsidiary brought in a tax of 225. It becomes yours to pay. So the difference I have 3650 plus 2, is it 225? All right, where are you? Income tax is 255. Wow, just have to be careful then. 255, so plus 255 plus 8,100 is 12 and 5. So 12,005 minus 7380. So I now have 4625. All right. So basically this is it. So we go into our cash book straight in, workings 3,005 and 4625. So straight. So income tax or first interest paid, workings 3,005. Income tax, workings 3 also, that is 4625. Still have it. So now we are done here. So 4625. So I have 5580 minus 1005 minus 4625. That gives me negative 545. All right, that is my net operating activity. So most of the time, we try to shift this one down so that we can designate it. So net cash flow from operating activities. All right, so that is that. Then we come to our investing activity. So all along, what we were doing was operating activity. So let's go and designate it well. So normally it starts from here, but let's just put here investing activity because in the beginning, operating activity. In the beginning, it is always about adjustment of the profit. Okay, so and it is within operating activity. So that is operating activities. All right. So for your information, like we learned, here you focus on your NCAs, investing activity. So the NCAs, well, so the PPE that we did, you will bring it in. The question said there's no acquisition and disposal for freehold. So it means PPE, we had something and we have acquisition. So PPE acquisition, the addition that came from our workings one. Let's go and bring it in. So we had what? 12,625, right? So that is what we have. 12,625. 12,625. If we had done the lease and it has declined, it would have been lease liability payment. So we wouldn't have brought it inside our PPE, our plant and equipment. So this one is not PPE per se, it is actually plant and equipment. So because the other one didn't have anything of that sort. So that is that. You focus right on your NCA. Apart from that NCA, we have investment in associates. We need to do a workings for this. Then we have also a financial asset. So you remember we had all these things inside the P&L. So the associate and the financial asset. So we need to do a nice workings for these ones. All right, to fish them out. So let me call it workings 4 and probably workings 5, something like that. Or put them together in a workings 4. So when I pick my financial asset, that is an asset. So, or investment in associate first. In associate. So I have balance brought down to be 15,000 coming from last year. And in my SPL, what do I have? So you go to your SPL, share of profit. You see, share of profit is not a cash flow. So what the associate will give you is money. The associate is an investment because it is not up to, we take it as investment, it's not up to control. So what they give you that will be a cash flow will be dividend, not the profit sharing. Profit sharing, you don't collect money, it is just theoretical. So what do they actually give you? So the SPL, how much is the share of profit is 5250. All right. Then the balance carried down is, where is it? So that we find anything, any difference thereof is like a dividend paid. So it's just like the way we will do my workings for dividend. So let me even call this one's dividend so that I will do it for the NCI as well, and also do it for the what? The group. So dividend calculation is that. So balance carried down is how much? Where are you? 16,500. So this one plus this one is like 250 minus 16,500. It tells you that he received a dividend. Dividend received inflow of 3750. The associate gave a dividend. So we will do same for our NCI. This question doesn't have a disposal. If you had a disposal, you know how to do a disposal, right? NCI dispose, you know how to do that. So from the video 2, we did the workings on that, how to find the NCI disposal. So we come to the NCI 2. What is the balance brought down? We are finding dividend, but for NCI, well, it's not an investing activity. You have control. It's your financing, all right? But since you are looking for dividend, you do dividend for all of them. So what is the NCI? Where is our balance sheet? NCI. It doesn't have a balance brought down. But share of profit to the NCI in the P&L, what do we have? Share of profit is 1,005. But we purchased, so the subsidiary that we brought in has an NCI of 945. All right, now our balance carried down of NCI. So if they were disposal to, you do disposal. All right, so that is that. Now our balance brought down is how much? NCI 1725. So 1,005 plus 945 minus 1725. That gives me a dividend paid by the NCI of 720. So that is that. That is financing. When we get to financing, we put it there. So since we are on the dividend, you do for the controlling part too. So all of them, group retained earnings. So that is working for, should be for all dividend. Balance brought down for group retained earnings. So group retained earnings, this is this, 37,500. What do? A share in the SPL, 18,675. Then we have our balance. We don't buy group retained earnings in subsidiary, so our balance carried down will be 51,675, meaning how much dividend has been paid. So you see these ones. All right, so this one is, and you see, when an associate pays dividend, it means that we will get our share of it. So in the video 2, I explained to you that if you own 100% share, every dividend that they paid is for you. All right, so that is that. But if you own what do we call it, a 75% or what do you call it, 80% or whatever percent, whatever they pay to outsiders or in general, you get that percentage. All right. So that is what you need to understand. Okay. So it's very, very important. It's very, very important. So that is why when you are doing this thing, you need to be very, very careful about this. So we've picked the NCI portion. These are the NCI portions already. All right. So that is that. And in this question, this is this like this one. It's a 75%. All right, of the shawarma business, and these are the purchase of your shawarma business. So your part of the NCI was this. All right, so basically that is that. So the dividend paid for this one, what is the difference? 37,500 plus 18,675, right? 18,675 from the sharing. Then I have 56. When I less 51,675, it means there's a dividend paid of 4,500. All right. So basically, this is that. Now we something brought us here, and apart from the dividend, we are going to do for the last thing of our what do we call it? Financial asset. It looks the same. It looks the same, no movement. So therefore, it means the figure that is here is the only difference, and it's an income from financing activity, financial asset. So what do? We have income from financial assets, which is investing, and dividend from associate. So income from a financial asset, then dividend. Don't forget, this is an outflow, all right? So the income from the financial asset is 3,000. Dividend received, so it will be received from the associate was how much? Where are you? 3,750. So we are receiving that. 3,750. So, ladies and gentlemen, this is how you go by it. So you see, you have tackled your NCAs. Have you tackled everything? Where are you? The NC. The only thing we are left to do will be the what we are doing in the subsidiary. All right. I mean the purchase of a subsidiary, how much we paid for that. Okay, so we are going to see that is that the purchase of a subsidiary. That is an investment activity also. So you could see that when we go up, we've dealt with goodwill, nothing happened to goodwill, change is zero, no impairment, nothing. We've dealt with this, we've dealt with all these except the cash part. So how much did we pay for investing in this guy? So investing in this guy, when we bought him, we had this. We've tackled these three things except the cash. All right. And so what is the net cash flow from the subsidiary? So subsidiary. When we bought him, we are paying a cash of 210. The other one was a share for share. We are paying a cash for 210, but he's bringing in a cash for us of 1680. So the net cash will be kind of an inflow. Is that not it? Yeah. So we are paying 210, an outflow, but it is bringing us 1680. That gives me a positive of 1470. So that is that. How much did we pay for the associate also? I don't think we found that. We weren't told that. So that purchase consideration would have also been a cash outflow. All right. So that is that. And so we can wrap up with this side. So always include purchase consideration for associate and also that for the NC, the subsidiary. All right. So I have this plus 3750 plus 3,000 or minus 12,625. I have in here 44. That is also negative 4405. All right, so this is it. Then lastly, I come to my, so like we do, let me just drag these ones down and designate it. All right. So net cash flow from investing. activities. So lastly, we come to the financing activity. Cash flow is the best. If you get it in the exams, that is the most easiest. All right. So you just have to make sure you have covered all the figures. As you can see, I've covered these figures, almost everything here. And I've covered the NCI. I've covered goodwill. The only thing yet to cover is this one. All right. That is that. And here too, what have I've done almost, I've covered so much of these things already, covered everything. So now in the financing side, where do we look at? NCL and what? Equity side. So that one too, we've covered everything here. So we are coming to cover everything here. All right, so I've already captured the NCI. I've captured lease liability. So we are left to loan notes and the equity side. So basically that is that. And even from the equity side, I have done two things already, the dividends. So the dividend that we had, so here, I think we did dividends already. All right, so we had NCI dividend of 720 and group dividend of also 4,500. This is the part of the dividend for you took control. So I mean, now that you have taken control, any declaration of dividend that is done, you are paying it out. And this one too, you are paying it to your shareholders. All right. So this is the part that you don't control, for which you are paying dividend. And this is the part that you also control, for which you are paying dividend to the shareholders. So they are all cash outflow. So 720 and 4,500. So it's very, very simple. So dividend. To NCI, right? Subsidiary, and also to the parent. Outflows of 720 and outflow of 4,500. All right, so that is that. So then we come to the ordinary shares. Here, it started like this, it has ended like this. But we saw that they used this one as also part of the associate. So the subsidiary. So why don't you do a last working for these ones? Or you can even do it on the surface of the what do we call it? The cash flow. You can do it there. But if you don't want to do it there, you can create a workings 5. You know that our stated capital brought down is how much. You can do it on the surface. You don't have to create a whole workings. You waste time with that, okay? But here we have 30,000. All right. Then we have the subsidiary. What is happening to the subsidiary? You issued shares, and that is bringing you in, where is that? 4125. After that issue, your balance carried down is how much? So your balance carried down is, you have 30,000 plus 4125. Now minus your balance. What is our balance? Where is the balance? 59,100. So minus 59,100. So what that brings in is a 24. So this one is an addition. 24,975. If you look at this one too, where is it? This one too. They say share premium brought down. That one, there is nothing else anywhere. So 31,425. Then the balance carried down is how much? So it means they will issue a shares on premium, which is 43,245. What is the difference? So inflow, additional issue bringing in the inflow. So 31,425 minus 43,245. That gives 11,820. So let's go and push these things in. All right, 24,975. I have the last one on my calculator. 24,975. So stated capital. I've forgotten again. 24,975. It's an inflow. 24,975. Then the other one, which is the share premium, which increased with 11,820. So the last thing that we are left with is the loan. That is it. So the long-term loan, this is it. We are told, so that one you can actually do it on the surface. With all these things, you can do it on the surface. So if I take my loan, for example, and I do 7,500, and we are told that there was a 600 that was included in the finance cost. Now this thing has gone up to 21,900. So what I have is 7,500 plus the 600 minus 21,900. That gives me 13,800, which means they issued additional 13,800. So these are the things that I have. Now, if I total everything up, I should be getting the balance. If I don't get the balance, then God help us. We will just take a quick glance through it and see where we've made a mistake. So you see, I've tackled all the figures inside this. So that is how you tackle a cash flow. Every figure is touched. Every figure is touched. So I have negative 720 minus 450 and 4,500 plus 24,975 plus 11,820 plus 13,800. And that gives me a 45,375. So that one, I'm going to keep it and deduct the top ones. But like I said, because of designation, let's push this one down here and call it net cash flow from financing activity. Financing. So I'll now total everything and get my net cash flow. All right, cash flow. Then, so I have this, so minus 4,405 minus 545. So I have here 40,425. All right, so I believe it will balance. We've tackled everything. 40,425. So what is the cash from beginning? Cash balance from the beginning. So cash at start. And it should be, our answer should also be equal to the cash at end. So what is the cash balances? So cash balances at end 6,7,725. That should be our balancing figure. So we should get, when we add our cash at start, which is 27, that it will balance. The 67 has come, then 300, making it balance. So ladies and gentlemen, this is how you go about it. It's the most easiest thing you can have, and I wish you pray for such in your exam. All right. So thank you very much and have a great day.